Welcome to The Explainer. Today, we're putting on our detective hats. Because look, if you follow the financial markets, you already know a fundamental truth. Surface-level earnings reports usually hide the real corporate strategy. That big, flashy headline number that gets plastered all over the financial news, it almost never tells the whole story. Sometimes, a company looks like it's totally struggling on paper, but it's actually pulling off a brilliant tactical maneuver behind the scenes. And other times, a company seems completely solid, but when you look at the underlying valuation, it tells a much more complicated, tension-filled story.
So, how exactly do you spot a hidden gem when a company's Q1 2026 earnings are giving you mixed signals? Okay, let's dive into this. To figure it out, we're going to act as lead investigators on two very different corporate case studies. First, we'll look at American States Water, a utility company caught in a fascinating valuation tug-of-war. Then, we'll pivot to Seacoast Banking Corporation of Florida, a regional bank that deliberately took a massive hit to its own income statement. By unpacking these two totally different scenarios, we're going to build a solid framework for how to actually read the strategy behind the numbers.
Let's crack open our first file, American States Water, or AWR, and what we'll call the valuation whipsaw. If you just glance at their Q1 26 results, honestly, you'd think things are going swimmingly. They reported earnings per share of 76 cents, which is a nice bump up from 70 cents in the same quarter last year. Overall revenues jumped by more than $21 million, mostly driven by new rate approvals and construction activity. Plus, their net cash from operating activities rose significantly to $71.6 million. But despite this really solid operational growth, you feel this immediate tension the second you look at how the market is pricing the stock.
We're looking at two entirely different ways to view the exact same company. On the bearish side, you've got investors pointing to a really rich price-to-earnings ratio of 22.6 times. To put that in perspective, that is well above the global water utilities average PE of 16.2. The bears also point to AWR's 2.62% dividend yield, noting that it has weaker free cash flow coverage and is backed by a balance sheet carrying relatively high debt. And hey, that's a totally valid concern for a utility. But then, you look at the bullish view. These investors are looking at AWR's discounted cash flow model and seeing a fair value of $101.84. Since the stock has been trading around $76, that means it's trading at a massive 24.5% discount to its fundamental fair value. So who's right here? The folks worried about the current debt and premium PE, or the ones drooling over that deep discount to long-term cash flow?
To solve that little mystery, you actually have to look at history. Specifically, this number, 71. That is the number of consecutive years American States Water has increased the dividends paid to its shareholders. They have paid common dividends every single year since 1931. Just let that sink in for a second. Increasing your dividend every single year for over 7 decades places AWR in a ridiculously exclusive, elite club of companies on the New York Stock Exchange.
That historical context, it completely changes how you view the stock. While the bears are hyper-focused on current leverage, the bulls are zooming way out. They're looking at this stated policy from the company to achieve a compound annual growth rate in the dividend of more than 7% over the long term. And AWR isn't just hoping this happens by magic. They're projecting a massive $185 to $225 million in capital expenditure for the full year of 2026 just to enhance their utility systems. They're also aggressively filing new electric and water rate cases to stabilize revenue. So our takeaway for AWR is that you really have to weigh the immediate balance sheet risks against a historic, near-century-long track record of rewarding shareholders.
Now that we've seen a pretty tricky valuation, it's time for a drastic shift in our investigation. What happens when the headline number looks terrible on purpose? Like, what do you do when a company's headline earnings look like an absolute disaster? Enter Seacoast Banking Corporation of Florida. For Q1 2026, Seacoast Bank reported a net income of $31.9 million. But buried right inside that headline is a massive $39.5 million pre-tax loss on securities. If you're just skimming the headlines, a nearly $40 million loss for a regional bank sounds terrifying, right? Especially given the volatility we've all seen in the banking sector lately. You'd probably just assume they made some terrible investments and are paying the price. But as earnings detectives, we don't assume, we dig.
Now, what's really interesting here is that this loss wasn't an accident at all. It was a highly calculated, strategic hit. Back in January 2026, taking advantage of their strong capital position, Seacoast executed what they call a strategic repositioning. Let's de-jargonize that for a second. The bank was holding on to about $277 million in low-rate, long-duration securities that were only yielding 1.9%. In a higher interest rate environment, holding on to those is a total drag on your earning power. So, they ripped the Band-Aid off, they sold those low-yielding securities, and willingly took a $39.5 million pre-tax loss right on the chin. Why? So they could take that $277 million in proceeds and immediately reinvest it into mortgage-backed securities that boast an average yield of 4.8%.
The immediate payoff of this bold move is actually pretty striking. By swallowing that short-term loss, Seacoast instantly pushed their overall portfolio yields up by 24 basis points, climbing from 4.13% in the prior quarter to 4.37% in Q1 2026. This isn't a bank recklessly losing money. This is a bank intentionally spending money to make its capital work much, much harder going forward.
And when you adjust the earnings to exclude that one-time strategic hit, the reality of Seacoast's quarter comes sharply into focus. Their adjusted net income was actually $67.8 million. That's a 42% increase from the prior quarter and a staggering 111% jump from the prior year. Because they moved their money into higher-yielding assets, their net interest margin, which is basically a critical metric showing the difference between what a bank earns on loans and pays on deposits, grew 17 basis points to a very healthy 3.83%. The underlying engine of this bank is absolutely roaring.
And this brilliantly illustrates that their strength isn't just coming from interest rates, it's also coming from core business relationships, particularly in wealth management. Since 2022, their assets under management have increased at a compound annual growth rate of 21%. They added another $125 million in new organic assets just in this first quarter alone, bringing total assets under management to $2.8 billion. This is high-quality, fee-based income that perfectly diversifies the revenue streams.
Furthermore, Seacoast isn't just playing offense with yield repositioning and wealth management. They are playing elite defense. They operate with what they accurately call a fortress balance sheet. Key safety metrics, like their Tier 1 capital ratio, sit at a super robust 14.6%, and their tangible equity to tangible assets, essentially what's left to cover losses if you had to liquidate the bank today, is incredibly strong at 9.24%. They are sitting on a massive pile of cash, over $808 million to be exact. In fact, between their cash and available borrowing capacity, they have liquidity sources representing 184% of their uninsured and uncollateralized deposits. They are so confident in this fortress that they actually went out and repurchased over 317,000 shares of their own stock during the quarter.
However, as impartial detectives, we always have to look at the full picture, and that includes insider activity. Despite this incredible balance sheet strength, some key insiders have actually taken a bit of money off the table recently. CEO Charles Schaefer sold over 10,000 shares, which reduced his personal position by 5.62%. Director Dennis Hudson III also sold 8,000 shares, representing a 3.27% decrease in his position.
So does this mean the insiders are jumping ship? Hardly. Overall corporate insider ownership remains at 1.5%, which is a very solid chunk for a multi-billion-dollar bank. Executives sell shares for a myriad of normal, personal financial reasons. Taxes, diversification, you name it. We have to balance that relatively minor selling data with the very confident posture the leadership is taking. As CEO Charles Schaefer stated, they are well-positioned to unlock the full earnings power of the combined franchise. As Seacoast enters its 100 year of operation, their aggressive repositioning suggests they genuinely believe their best earnings days are still ahead of them. So the crucial point we've uncovered today is that in the financial markets, first impressions can be deeply, deeply misleading. Let's quickly review our case files. With American States Water, we saw how a seemingly overpriced stock might actually be a deep value play if you trust their long-term discounted cash flow and respect that incredible 71-year dividend growth streak. With Seacoast Bank, we learned that a terrifying headline loss was actually a brilliant strategic maneuver to turbocharge their long-term net interest margin, all while sitting safely inside a fortress balance sheet.
Ultimately, the lesson of this explainer is simple. The next time you see a flashy earnings report cross your screen, I want you to stop and ask yourself, are you reading the headlines or are you reading the strategy? Because as we've seen today, the market's true hidden gems are always found in the latter. Thanks so much for joining me and keep digging into those numbers.